So our dog of the week is Lucid Group LCID on the NASDAQ. The company designs, engineers, and manufactures electric vehicles. The current share price is about $254 with a market cap of just under $6 billion. The share price is down 26% over the last month, but it's down a whopping over 95% since its all-time high set in late 2021, which is a recurring theme with many of these more speculative companies. So first look at why the company has been on a decline really since 2021. First and foremost, the company's valuation was just extreme at the time. It was just very, very high on top of just the general feverish broad market valuations at the time. The company was just beginning to start customer vehicle manufacturing at its Arizona facility. Optimism was high for Lucid as a whole and as well as the market, which resulted in a massive market cap peaking at $91 billion. With an order book, so what they're expecting for future revenue, not even current revenue of $1.3 billion. So huge, massive growth was just baked into the stock price at the time and the company as a whole. Now, just under 3 years later, what has the company done? They were able to have at least commercial production and delivers in 2022, but growth has been very, very, very underwhelming compared to what was expected at the time, implied by the stock price. As of the last quarter, Q2 2024, the company delivered 2,394 vehicles, resulting in revenue of about $200 million. On a per share basis, that's only 9 cents per share. That's lower than the all-time per share revenue of 15 cents, all-time high per share revenue. And that was just set in Q4 2022. And that Q3, Q4 2022 was really that's when they had their initial bookings hit and were actually sold. Roughly the same, and that per share revenue has been roughly the same since Q1 2023. Even with rising absolute revenue, the per share dilution has just further hindered any per share growth. So over the past few years, the company just has not been able to really keep up with any implied expectations of growth given by its price at the time. Now, looking into the last month, the reason why we saw the stock just fall 26% over the past couple of weeks is that there was another stock offering of 262 million shares and a further private placement of 374 million to the majority shareholder, the Saudi Public Investment Fund, which owns 59% of the company, and they were offered that to keep their share ownership the same. Effectively, they run the company. Here, together, those two offerings raised approximately 1.67 billion and raising the share count by about 27%. So overall, really, you have a poor financial performance, burning just large amounts of cash quarter after quarter, year after year now, and the need for cash injections through dilution in a significantly now poor environment for capital raising compared to a few years ago just really has resulted in this poor stock performance. And really, there's a lot more pessimism now than what you would have seen even a couple years ago or a year ago, which has just devastated the share price and made Lucid our dog of the week.
Yeah, I did a little bit of a look at Lucid in our 2023 electrification report. And I mean, at that time, we could look at it now to continue to see how much they've been burning. But at that time, it was as of March 31st, 2023, the company had an accumulative deficit of 8.1 billion. So, that's essentially like money that they've been just like burning or investing. And again, they're not nowhere near profitability. It's just grim, I feel like, in the space,
It looks gross to me. I wouldn't be anywhere near it. Yeah. It's really, sometimes, I don't know if we need to delve in that much deeper than, there was revenue growth. The revenue growth is even plateaued really here. And it's, the losses are extensive and it doesn't look anywhere close to profitability. That is a capital intensive industry. Yeah. Good luck is what I would say in that business at this stage, unless it gets acquired or I don't know.
It's capital intensive and they're even though you do get some economy of scales in your cost of goods sold, they're not even making a gross profit at this point. So even at the time they're losing money per vehicle, they're not selling at a high enough price effectively.
Yeah, it's ugly.